Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Once every single quarter, I like to look at what investors are buying. So I'm talking about the hedge fund managers. Normally that kind of gives me an idea of, some of the companies that could potentially be undervalued. So I like to look at the list, and sometimes I don't agree with them, but sometimes I do. And I don't really focus on them just too much, or don't put more emphasis on any specific hedge fund manager. So I just like to get a feel of what they're buying and then look at how much of that company they're buying and so on, and just kind of giving me an idea, for an investment, and then I can do my research. And that's the bit that's really important. Sometimes you see stocks that I'm buying, don't just buy them because I bought it, okay? Because I might have a completely different idea to what you actually, or maybe I have a different investment strategy, okay? My time horizon might be different. So, and these guys normally, by the time we actually finish this video, they might have actually sold that stock. So that's another thing we also need to be careful, because they only need to publish it months after they've actually bought this stock. By then they could have sold it, made quick money, and then we left to hold in the bag. So you really have to be careful. But I like to look at the hedge fund managers, what they're buying in that quarter, just to kind of give us some ideas. So I put together 10 stocks today just to have a look at. Okay, and then what we're going to do, also look at their Sharia compliance side of things as well. So some of these companies have actually been in this list the last time where we did it. Some of them have actually slightly changed. But before all of that, let me just quickly talk about just the general markets. And as you can see, it has been a red week this week. I don't know if that is going to improve next few weeks. Right now, the sentiment is basically not great. People are worried about their jobs and all sorts of things. The interest rates are going up. They have, the Fed in the US are not actually helping the stock market generally like they have been in the last months, last 2 years. So right now, you just have to really be careful of in terms of investing, but look for stocks that you potentially want to add to your portfolio that are really undervalued at the moment, and just be ready just in case it actually goes down any further. If you have money in the stock market right now that you need in the next couple of months, then just be careful, honestly. But if you don't need, so this 50 something thousand I've got right now is not a money that I actually need. God forbid I don't need it right now, okay? And I do have my little bit of cushion of money that right now I can put into the market or use it, okay? On top of that, I still have, alhamdulillah, I still have my emergency fund of up to 5 months, and that is very important. So once you've got all of that, then you just have to basically stop worrying about the stock market and keep buying it. As you can see, at one point, I think it was last video, the video before, we were £8,000 up. Right now we're half of that, and this can easily happen. So you just have to be careful. Just keep buying. Companies like 3M, it was in the positive a week ago. Right now it's in the negative. So just to be mindful, the stock market is, can go up one day, can go down next day, but think about your long-term plan. Right, let's have a look at what we're looking at today. So we're looking at the ticker, the company, the sector, Morningstar economic moat rating, which is a competitive advantage if you like. Okay, and then we're looking for these 3 elements that we're looking for. We're looking for a non economic moat. We're looking for narrow, we're looking for wide, and we're looking for, that's it, just the 3. Okay, and then we're looking at the dividend yield, if they have any dividends. Some of the stocks today do not have any dividends, and if they have a dividends, we're looking for the 5-year growth rate. We're looking at the payout ratio, so how much of the net income they're spending basically given to us as a dividend. We're looking at the 5-year dividend increases. We're looking at years of increasing that dividend. The safety, we're looking for the margin, profit margin, the free cash flow. Okay, we're looking for total to return in the last 10 years, and the next 5 years was in terms of returns. How much, in terms of the growth of the revenue, how much are they going to grow? Morningstar valuation, the price side of things, and then what the fair value of that company is. So let's have a look at the first company, and this is no surprise, Microsoft, a company that I if I can talk, definitely think right now is undervalued, and 10 hedge fund managers actually bought this company just in the last quarter. As you can see, it has a wide economic moat. dividend less than 1%. It has a 5-year growth rate of 10%. They have payout ratio of only 25%. Years dividend increases about 16%, 16 years, apologies, and then safety of 99%, which is absolutely amazing. Profit margin, we're looking at about 37%. Free cash flow, we're looking at about $65 billion, and then total return over the last 10 years is about 24%, almost 25%. And right now, next 5 years, they're expecting this company to grow their earnings every single year about 15%. Morningstar valuation is about 26% discounted right now based on their calculation, and they're expecting the price to be 300, and their fair value is $352 per share. The next company we look at is Moody's. Moody's is a credit company. So what they do is basically they look at the financials of other companies, they issue credit rating and so on. They have a wide economic moat, less than 1% dividend yield, 11% of 5-year growth rate, payout ratio about 28%. In the last 21 years, they have been increasing that dividend, which is absolutely amazing. So soon they will be a dividend aristocrat. Safety, we're looking at about 83%. Profit margin, about 29%. Free cash flow of $1.2 billion. That covers the dividends. Okay. And then 22%, 22.5% total return in the last 10 years, which is absolutely amazing. Growth next 5 years, we're expecting about 5%, fairly valued at the moment, $310 per share. I own SPGI, which is very similar to this company. So that's one of the reasons I don't own it. In fact, I did own it at some point. I sold it. It wasn't a huge position, but it was quite a small one. By the way, apologies if my voice is all over the place. I'm kind of a little bit suffering from a bit of cold at the moment, so apologies. Okay. So the next thing we're looking at is the next company is Adobe. As you can see, Adobe is one of the companies I own in my portfolio. It has a wide economic moat. Profit margin about 20, so they don't pay any dividends, by the way. They have a profit margin of almost 30%, free cash flow of $6.8 billion, and then total return in the last 10 years, you would have made, when we say total returns, we're talking about basically dividends as well as the price appreciation, okay, capital gains. So you would have made about 28% in the last 10 years, every single year of the last 10 years. Growth, we're expecting basically next 5 years about 14% and 25% discounted. Right now, their price target is $500 per share. The next company is another one that I own, Salesforce. They have been buying. So Adobe, Moody's, basically 7 different hedge fund managers actually bought it. Adobe, 7 have bought it as well, and Salesforce, 6 different hedge fund managers actually bought it just in the last quarter. They don't pay any dividends, and as you can see, profit margin is 1.80, free cash flow of $5.6 billion, and this is one of the things I love about this company. Okay, it is definitely a cash machine, but right now obviously they still in that stage of reinvesting into the business. So they bought company like Slack not long ago, I think it was 2020, and that's actually now, when you look at the financials, is actually added quite a bit into their revenue, which is really nice to see. So it's still in the growth phase, as you can see, and total return for the last 15 years is about 16%. And the next 5 years, every single year, they're expecting the earnings to grow about 15%. And as you can see here right now, 35% discounted, $240 per share is the price target from Morningstar. So another great company. I use basically, I think I own 10 shares right now. I trimmed it recently because I was tech heavy. So just kind of managing the portfolio. So I trimmed it a little bit, but I'm still bullish on this company, and I'm not going to sell those 10 shares for any time soon. Next company they have bought recently, and they bought 6 different hedge fund managers actually bought this, is MasterCard. Even last quarter when we did this, it was also included. I think Adobe was included and Microsoft was included in that list as well. As you can see, their dividend is not great, okay, 0.61. But if you're thinking about the price appreciation, if you've got a long time horizon, then this is a great company. 18% growth in 5-year growth rate of dividends wise in the last 5 years. Payout ratio looking about 0. That's actually not right. Yeah, probably is, because wait, I need to double check that. Yeah, according to Seeking Alpha, it's actually about 19%. So that is not correct. Okay, so I'll check that out later. And as you can see, 15 years of increasing that dividend, 99% safety, 46% profit margin, which is absolutely huge. MasterCard and Visa both have huge profit margins, and free cash flow, $9 billion. Total return in the last 10 years, about 23% growth in the next 5 years. So every single year, they're expecting their earnings to grow about 33%. Fairly valued at the moment, $369 per share. That's what they're expecting. Guess what the next company is? And that's Visa. So again, they're buying more Visa. They're buying about 6 different hedge fund managers actually buying this company. It has a white mode. In terms of dividend, it's quite low, but 15 years of 15% growth in the last 5 years. Payout ratio only 21%. 14 years of increasing that dividend, and safety 99%, which is the highest you can get. Profit margin 50%, like I said earlier, almost 51%. Free cash flow here, we're looking at about $16 billion and 20% total return in the last 10 years. 18% growth in the next 5 years. That's the expectation. Again, this is just expectation, is not done deal kind of thing. Fairly valued, well, discounted at the moment. 229 is their price target. Okay. The next company we're looking at, I think was on the list last time as well. 8 different stock hedge fund managers are actually buying. So 8 different hedge fund managers have actually bought this company just last quarter. And as you can see, it was on the last video that we did as well on the hedge fund managers, the similar kind of video. And Morningstar, economic mode rate, basically has about wide mode. I can't even talk today. Profit margin of 12%. Free cash flow of $5.8 billion. Total return in the last 10 years, we're looking at about 12%. And then in terms of next 5 years, they're expecting 51%. And this is probably why, this explains a lot. When I saw this, I'm like, that is really high. 51% growth every single year in the next 5 years. That's ridiculously high, right? Maybe it's because of COVID. Maybe we're going back to the good old days. I don't know what this, maybe there's a demand that's been, I don't know. We'll see what happens, but that's the expectation. 37% discounted right now. $3,000 the expected price for that company. The next one is the Dollar General Corporation. Is a defensive stock. It has a narrow economic moat. 0.91% dividend yield, 5-year growth rate of 11%, payout ratio only 14%, which is really nice. 6 years of increase in that dividend, and safety about 64%. 61 and above is the cutoff, so that's quite good. Profit margin 6.5, not great. 1.2 billion dollars of free cash flow, and 17% growth in the last 10 years in terms of total return. But this is probably it, because this is a stock, basically a stock that never moves, but about 11.46% growth expected for the next 5 years, which is quite nice. Fairly valued at the moment, $227 per share. The next company we're looking at is Texas Instrument. I'm going to do a video on this company. I'm interested in terms of like to see what it's like, but I don't know if I should add more, obviously semiconductor company. But as you can see here, it seems really interesting. So I'm going to do a video just to kind of go over it. And I think one of the subscribers have asked me recently, so we'll see. It has a wide economic moat, 2.82% dividend yield, 21% 5-year growth rate, 48% payout ratio, 33 years of increasing that dividend. So they are dividend aristocrat. And safety, we're looking at about 90%, 43.6% profit margin, which is very high. $5.88 billion of free cash flow, and the last 10 years they've actually returned 20% to investors. And next 5 years they're expecting about 10%. Fairly valued at the moment, $166 per share. Final company we're looking at is the company that I've included in my portfolio very recently. If you haven't seen that video, go and watch it. As you can see, it has a wide economic moat that's been changed recently from a narrow to a wide. 3.4% dividend yield, 5-year growth rate of just 6%, payout ratio 52%, 11 years of increase in that dividend, and safety 91%. Profit margin almost 23%. They have $13.5 billion in the bank to do whatever they want to do with. Total return in the last 10 years, we're looking at about 11%, 7% growth in the next 5 years, and it's right now it's discounted about 17% according to Morningstar, and $54 per share. That's the expectation. Now, what I'm going to do quickly is show you all of these companies, okay, and there, so you can pause the video, you can have a quick look, but every single one of these companies is Sharia compliant, so you just have to look at it. Microsoft is the one that I've always said, although according to Zoya and whatever, it says that is questionable. One of the reasons they said it's questionable is because the revenue that comes from Bing and the advertisement, which if you look at the actual financials, is almost non-existent. Okay, they have more, basically there's way less than, I'm sure last time I checked, it was less than 2% or whatever it was, that basically the total revenue. So it's almost non-existent unless it grows in the next few years and it changes completely. Then I'm more than happy to look at it again. But for now, I'm definitely comfortable holding this company. There's no issues with it. And there's a few things that I'm actually right now, I've written an email to Zoya waiting for a reply, because there's one company, I think it was one of the REITs that we don't own anyway, that has been changed for recently. I think with DLR or whatever, I think they've changed it to Sharia compliant, but the company is definitely not Sharia compliant. So we'll see as soon as I get some information on that. If you don't know, if you own that stock, I will let you know. As you can see, the portfolio is still the same. Okay, well, not the same, nothing is new in terms of adding new money, whatever, but as you can see, it's quite bit down this week. I think from, let's start from, what was it, 58,000 to where it is right now. So it's been a crazy week, but it doesn't matter. I'm still gonna add more money next week, and we'll do a whole video next week. If you are still interested, I think now Trading 212, if you live in the UK, Trading 212 is now open for opening an account. So use the link in my description. I think one of the brothers has used it. Thank you. I don't know, sisters, I don't know who it is. I haven't checked any of my comments. So let me know if you actually use this. Okay, because I don't know who basically used this, but someone actually used it. And I've got Under Armour. It's a Sharia compliant company, so I might actually just leave it there, or I might sell it and then give it to charity, inshallah. But either way, because it's Sharia compliant, I can leave it here. If you end up getting a share that's non-compliant, just sell it and give the money to charity. That's what I normally do. Okay, but yeah, I'm going to stop the video there. Have a wonderful day. I will be doing a whole portfolio update soon. Talk about dividends, everything that have been happening, inshallah, as soon as my voice is better. Assalamu Alaikum. Take care.